Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking all about the recent downgrade of US government debt. You may have read or heard somewhere that Moody's downgraded the US government's credit rating from AAA or AAA to AA+, which is one rung down on the ladder. We're getting a lot of questions about this. You might be wondering what this means for the stock markets, the bond markets, your portfolio, the US government, our future, and the dollar's state or status as the world's reserve currency. And we cover all those topics in today's show. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. This week's podcast episode is talking about the U.S. government debt credit rating and what just happened recently. You may have heard in the news or read something about the fact that one of the credit rating agencies dropped the credit rating of U.S. government debt from AAA to AA+. So what I want to do on today's show is just talk through what this means. A lot of people are really concerned about this. Does that mean that the bond market is going to dissolve or the bonds in my portfolio safe at this point? Will this result in a stock market crash? There's been a lot of hyperbole, I think, related to this. If you watch CNBC, they're doing a lot of bombastic stuff in order to sell advertisements to viewers, and they tend to blow this stuff way out of proportion, way out of control. This has happened before. I don't think it's going to be anything that makes substantial waves in the market, and that's precisely what we've seen. I'm sitting here recording this on a Friday. This happened just a few days ago, and market sold off by maybe 1% here a few days ago, the day following Fitch's announcement. And then in the few days since then, they've recovered all that lost ground and are even higher than they were before the announcement was made. So this isn't a huge deal, but it's interesting and something that we should talk through because it does impact the markets. It impacts the capital system in the U.S. around the globe. And to some degree, it does have a small impact on your portfolio and mine. So we should probably start with exactly what happened and what it means. And to lay some groundwork for this, there is a huge bond market around the world. We think when I say the word capital markets, most people I think are probably thinking of the stock markets and specifically like the New York Stock Exchange, where investors can go take cash and exchange that cash with somebody else for shares in various companies. And years ago, that all took place physically with a lot of yelling and screaming on the floor of an exchange and papers flying in the air and all that stuff. That doesn't really happen anymore. The New York Stock Exchange still exists. They shoot a lot of videos from the floor of the New York Stock Exchange because it's kind of an interesting thing for people to see. But the vast majority of trading volume of stocks is being transacted electronically. All this exchange of cash for stocks and stocks for stocks and all the purchase and selling that you and I might engage in is all pretty much done electronically these days, which is a far more efficient way to buy and sell stocks, and is really better for the investing public. Now, the bond market exists, and it is quite a bit different. And it's in terms of volume around the globe, the bond market is way, way larger than the stock market. The main reason for that is it's just more common for companies and organizations to borrow money using some kind of debt obligation. And think of it, if you're, this is true of small businesses too, right? If you want to borrow $100,000 to go buy some piece of equipment in like a manufacturing company, you're probably less likely to go out and issue shares of your company and sell equity to raise that cash than you are just to walk into a bank and ask for a loan, right? Big corporations, and it's a little bit of apples to oranges here because mega corporations have already gone public and shares of equity are exchanged all the time. So they're comfortable raising money from the equity markets and selling new shares of stock. Nevertheless, a lot of companies don't want to dilute their equity base because if they sell more shares, if there's 1,000 shares of Coca-Cola that exist in the world, and now they want to raise money, and so they go out and they sell 100 more shares of Coca-Cola in exchange for cash to the company. Well, if you held one of the first 1,000 shares, you owned 1 divided by 1,000. That was your share of Coca-Cola of the company. Well, if they sell another 100 shares, guess what? You've just been diluted. Now you own 1 divided by 1,100 because 100 new shares have just been issued. So long story short, companies are often far more interested in borrowing money through the debt markets. That has definitely been true over the last 10, 15 years, given that interest rates have been super low. Now companies may be rethinking that the borrowing costs have gone up a little bit. But the bond market is much bigger than the stock market. Now, credit rating agencies exist to help investors gauge the capacity and the willingness of a borrower to pay you back. And this is important. If you go out and you buy shares, equity shares of Coca-Cola, you have all the public financials. You know what their income statement and their balance sheet looks like. They're all audited. You have all these statements that executives in the company are required to put in about their expectations, what they're working on, to give you what you need to make an informed decision as an investor. They have to do the same thing in bond issues. But the thing is, there are far fewer share classes of equity than there are of bonds. Okay? So if in our example, if there's 1,000 shares of Coca-Cola and now they want to raise some cash, and so they go out to the market and they sell 100 more shares of Coca-Cola, those are probably going to be the same class of shares as the first 1,000. Meaning voting rights are going to be the same. Your claim to the company earnings are going to be the same, right? It's just a share of common stock for one and all. In a bond, Coca-Cola might want to raise the same amount of money in 1 year by selling 10-year bonds at like 5% interest. And so they go out to the bond market, they borrow a bunch of money, and they promise to pay whoever lends them the money interest every 6 months at 5% per year. And then at the end of the 10 years, they'll pay all the money back. Well, in year 2, they might want to raise some more money for another reason. Year 2's issue might be a little bit different. They might look at the market and say, hey, look, now we think we want to do it over a 5-year time horizon because that matches our needs a little bit more or a little bit better. So they issue bonds, they pay interest over the 5 years, and then they pay the money back in 5 years. Well, those are 2 very different types of bonds. The shares of stock are just shares of stock. They're one and the same. And so Coca-Cola might have, if you're an investor and you want to buy bonds issued by Coca-Cola, you might call your broker or log in and look at what's available. There might be 50 different types of bonds that you could buy of Coca-Cola. They're all going to have different percentages next to them and different maturity dates, and it's kind of confusing. And so credit rating agencies are helpful because they gauge capacity and willingness to pay back bondholders. And you would think that if I buy bond number 1 of Coca-Cola, Coke's capacity and willingness to pay me back on bond number 1 over 10 years is going to be the same as bond number 2 over 5 years. And that's exactly the same, right? Their cash flow, their free cash available to pay down debt, their balance sheet, that's all going to be the same for all types of bonds that they might issue. But the primary reason that these rating agencies exist is to gauge capacity and willingness to pay back all bondholders. And I think they do comment a little bit on the specific issues over time. So they're back to why we're talking about this. There are three main issuers in that do this. Standard & Poor's does it, Moody's does it, and Fitch. Those companies have been around for a long time. Standard & Poor's obviously maintains the index, the S&P 500. They also do all this other stuff, credit ratings included. And so when they're weighing in an opinion on an organization's capacity and willingness to pay them back, they're looking at the strength of their financials. They're looking at the forward outlook, how much cash is coming in. If they're being aggressive and growing and they don't have a whole lot of cash left over to pay down debt, well, you're not likely to get as good a credit rating as you are if you have a whole lot of cash flow coming in and a lot of flexibility in terms of paying down that debt and making interest payments. So it's a very helpful thing to be aware of. So there are a number of factors that go into how these credit ratings are produced. They vary a little bit. Each company's process is probably a little bit different. They have a committee. There's a lot of people involved. It's a formalized process to make sure that they're presenting their accurate and true opinion of the issuer's, again, capacity and willingness to pay you back. U.S. government debt is about the safest type of debt that you can buy. It's no different than a bond issued by Coca-Cola. If Coca-Cola wants to buy a whole bunch of new factories and make a whole bunch more Coke, they have a choice. They can issue stock. They can go to the bond market, issue bonds. They pay you interest, and they pay you back after a certain time. The U.S. government needs to borrow money to finance its operations too. So they issue all these bonds to the markets. They pay a little bit of interest. And then when the bond matures, if it's a 5-year bond, they pay you interest every 6 months, and then at the end of the 5 years, they give you your money back. Well, the U.S. government has the ability to print its own money, which we're pretty good at if you've been following along for the last 10 years or so. So the capacity of the U.S. government to pay back, if you buy a $10,000 U.S. government bond, the U.S. government's capacity to give you your 10 grand back when the deal is over, when that bond matures, is very, very high, because we have the strongest, most diverse economy in the world, and the amount of cash we take in from tax revenues every single year is just astronomical. So we have the capacity. But that doesn't mean that the U.S. government is always going to pay you back, right? Capacity is not everything, and that's why we look at the second factor, which is willingness. And this was Fitch's point. Their comments after communicating that they had downgraded the U.S. debt or their argument for doing so was, and I quote here, expected fiscal deterioration over the next 3 years and less governments due to political standoffs and instability. So what they're expecting is that the federal budget deficit is going to go up. I think the last year it was 3.7%. Their forecast is that it's going to go up to 6.5 or 6.7%. I can't recall at the moment. And that, coupled with the fact that we just had this debt limit issue that is kind of fabricated, the amount of debt that we can borrow as a federal government is always, held hostage for political reasons. And so back in May, knowing that there was, all these heated arguments and we were about to run out of money in the federal government, Fitch put the U.S. government debt on watch back in May. We resolved the issue in June, and now in the end of July, I believe it was the end of July, maybe August 1st, something right around there. They just announced that they're downgrading the debt from AAA to AA+, which is just the next rung down on the ladder. So that's what's going on here. Fitch thinks that we'll have a deteriorating economic environment. They also commented on the likelihood of recession at the end of this year and the beginning of next year. They said, yeah, it's possible we might hit a mild recession, but the numbers do look like they're improving. They're more concerned about our political instability and the fact that we can't ever come to an agreement when it's time to raise the debt ceiling again, and we keep adding to our aggregate federal debt and our debt as a percentage of GDP that we produce every year. So a couple things to think about here. One of them is, what is the deal with the timing of this? Did new information come out? This is a question I'm kind of asking myself, and it's something that I think a lot of market participants and followers have. Number two, does this have broader reach for other bonds in the market and potentially the stocks? Has it happened before? Can we use that as a guide? And number four, the other thing that comes to mind is a lot of institutional investors and a lot of mutual funds and ETF managers have investment mandates. And what that means is here's the pot of money in the portfolio. You're only allowed to buy stuff that meets certain criteria. So if you go and buy a US government bond mutual fund, you should not expect to have shares, equity shares of Tesla in that portfolio, right? There's a mandate, an investment mandate of you're not allowed to invest in that stuff. Part of these mandates are often that we have to have a certain amount of the portfolio. Let's say it's a bond portfolio only. A certain portion of the portfolio has to be in AAA rated securities. And sometimes that might be in a very safe, conservative bond portfolio, a very substantial portion of the money in the pot. And if the U.S. government debt has been downgraded and no longer fits that criteria of AAA, does that mean that investment managers with these mandates are going to have to make substantial changes to their portfolio? And could that potentially disrupt the bond markets? That's another question that came to mind. So those are the four things that I want to cover today. And I did a little bit of homework before this episode, which is more than I often do, as some people, if you've been listening, you might know. So why don't we cover these things one by one? Number one is, and now that I'm walking through, I said that I did homework and then I forgot my sequence and what order we just went over that stuff on. So bear with me just a second here. Why don't we start with, has this happened before? And should we care about whether this has broader reach into bond markets and or stock markets? So, I'm sorry. Let me backtrack. The first part of it is, what is the deal with the timing here? Usually, let's compare these credit rating agencies to stock analysts. There are all these stock analysts that give forecasts about what they think an equity is going to do, and they take all the information available to them, all the balance sheet and income statement stuff we were talking about earlier, and then remember that publicly traded companies are required to hold earnings calls every single quarter. Well, I don't know if they're required to hold calls, but they're required to report their earnings every single quarter. And to communicate what's going on and field questions, they hold an earnings call, which is where like stock analysts are allowed to come, and there's a Q&A with management, and just give the analysts a better feel for what's behind the numbers that they just announced. And with stocks, these analysts are following everything going on with the stocks. They're following the news. They're following these earnings announcements and numbers, and then they're asking really pointed questions. And it's very common that a stock analyst might have a price target for a given company of, say, $75 a share, and then and that $75 a share target should, if they're doing their job, convey or consider all the information available to them. But then when earnings are announced and that earnings call is held, often they revise their price target because now new information is available. So if the company had a really good quarter, the analyst was expecting earnings of 25 cents a share, just pulling that out of a hat, and the company announces 32 cents a share of earnings, well, that's good. That's obviously positive. The market will probably like that, and the price target that the analyst might be forecasting, they might decide to increase it as a result of those earnings in the following conversation. But that's all because the only reason that they're revising their price target is because new information has become available. Well, what Fitch did was put U.S. government debt, or more specifically, the U.S. government as an issuer, on watch back in May. And then they're tracking all the macroeconomic information. We come to a political resolution to raise the debt ceiling and alleviate that problem temporarily. We have to come back to the table at some point in the future. I can't remember when the deadline is. And then it's quiet for a little while. And then all of a sudden, Fitch announces that they've reduced the credit rating from AAA to AA+, but it's not like any new information has recently been announced. You know, the information they're looking at are inflation numbers, deficit numbers, budget, GDP, those things. None of those announcements came out recently. So it's an announcement that makes me raise an eyebrow because they, must have just had their ordinary investment committee meeting and come to the conclusion that U.S. government debt is now AA plus instead of AAA. But it seems like if they were really on top of it, they would have had that discussion right after the debt ceiling issue was alleviated, and then made their decision and come to the conclusion then. Or maybe if there was like an inflation or GDP announcement recently, that's when they would have done it, right? But their decision didn't coincide with any of this stuff, which is odd. There are a couple people I follow that had comments on this. One of them is Mohammed El-Arian, who's really good with macroeconomic stuff, and his thoughts on it were, and I think his words were, this choice to downgrade the credit rating is bizarre and inept. Janet Yellen, who was the Treasury Secretary, thought that the downgrade was outdated. Outdated was the word she used. We've got to kind of keep her comments at arm's length because she's biased. She is the Treasury Secretary. She's in the Biden administration. She's going to try to make things look good no matter what, right? So we kind of have to take that opinion for a grain of salt right now. But El-Arian is smart. He's been around for a long time, and he is far more objective. So the timing kind of made me raise an eyebrow. A lot of other people felt the same way. And it just didn't rely on any new information. They just changed their forecast. So what does this mean for the broader market? Should we be more concerned about our other bonds? This has happened a couple times. The last time it happened, remember there are 3 of these credit rating agencies. The last time it happened was in 2011. There was a big debt ceiling standoff back in 2011, and Standard & Poor's reduced its credit rating of the U.S. government debt to the next rung down. The tiers for these in Moody's went from AAA down to AA+. The way that they describe these tiers is a little bit different across the 3 credit rating agencies. S&P's might be AAB, if I recall, but for all intents and purposes, they just went down one rung for the exact same reason. They were not totally confident in the fiscal environment for the U.S. government, and we had this political instability surrounding whether or not they're going to be even legally allowed to borrow more money. And so the markets at that time didn't like that. They made that announcement. Markets sold off over the next few days, maybe a couple weeks, by 6.5%, which is very substantial, right? That was a totally different economic environment. In 2011, the mortgage crisis was just really fresh on everybody's minds. We hadn't yet recovered from that in terms of an economy or the stock market. The stock markets had bounced back substantially, but we weren't out of the woods. A lot of people who were, in over their head with regard to mortgage borrowings and rental properties and that kind of stuff had to default on those properties, foreclose and walk away from them. It was just a very fresh wound. On top of the fact that stocks were already in correction territory, it just kind of enhanced the momentum, and credit spreads were tightening at the time. And what that means is that the difference in interest that you get between investing in a corporation and the US government is called a credit spread. And if you think that the US government is the lowest credit risk in the world, meaning the most likely to pay you back on a bond, maybe a 5-year bond from the US government might come with like a 4% interest rate. Well, if the same 5-year bond for Coca-Cola comes at a 5% interest rate, the credit spread is 1%. And that spread indicates the risk that Coca-Cola defaults. Can the U.S. government default? Yeah, if we don't come to an agreement on the debt ceiling. But even if we did default, it's a very short-term thing because at some point it will get resolved. Coca-Cola can go bankrupt. And so that 1% extra interest is called the credit spread. And back in 2011, credit spreads were tightening. They were going down, meaning that the amount of extra interest you get for investing in corporations was a lot lower. Right now, interest rates are rising, credit spreads are expanding, and the momentum on stocks is fine. So it's a very different environment. It happened. Moody's actually back in 1994 downgraded US debt back then temporarily as well. And I don't have the numbers off the top of my head about what the stock markets did at that time. But my point is that we're just in a much different environment right now. Inflation is coming down substantially. Every single month that the inflation numbers have been printed, it's gone down. We might have a small recession starting later in the year. That's potentially possible. But the numbers the macroeconomic numbers are improving every single month that data is printed. Moody's point is that the federal government is spending money into a deficit. And if we have $100 billion coming in from tax receipts to the federal government in a given year, and the federal government has a budget of $100 billion and spends $100 billion, then the deficit is zero. If it spends $110 billion, then we have a $10 billion deficit, which is 10%. So that's what Moody's point was, is that based on what our budget is and what the forecasted tax receipts look like, our budget deficit will be increasing in 2023. And that, again, alongside with the political instability side of it, is what makes the U.S. government's capacity and willingness to pay us back just slightly less likely. So we haven't seen a disruption in the bond markets. We haven't seen a disruption in the stock markets. One other possibility that would come to mind as well, if U.S. government debt is downgraded, does that mean that people are going to sell U.S. government bonds all of a sudden and rush to bonds of other governments or bonds of highly rated corporations? We haven't seen that. I don't think that's going to happen. Remember that the exorbitant privilege here of the U.S. government is that we get to print our own money, and that happens to be the world's reserve currency still. And our competitive advantage there on the world stage is going down a little bit every year, but we've got a long way to go until anything else supplants the U.S. dollar as the world's reserve currency. So because we can just print more money when we need to, I'm not saying that we should. I'm not saying that's good for us as a country or for any of us individually as investors and citizens, but we can. That's generally what governments like to do when things get tight. And I think it's just an exceptionally low possibility that U.S. government bondholders will lose their principal and never get their money back. So it's just a different situation. Now, finally, the last thing, and this was part of my homework, goes back to those investment mandates. If you buy a mutual fund, if you buy an ETF, there's a prospectus that is a legal document outlining what the portfolio will invest in, what the strategy is going to be, who the managers are, to give you information you need to make a good decision on whether to buy or sell. And that's part of their public disclosure process mandated by the SEC. And so there are parameters. If you buy a U.S. government bond fund, that's what the portfolio manager can invest in. And this is not true in just mutual funds and ETFs that you and I might buy, by the way. This is true for large institutional managers, for pension funds, for endowments. There are investment mandates embedded in investment policy statements for large pools of money, because that's the prudent way to handle it. So a lot of those mandates are organized by credit rating. If you have a diverse, let's say that it's an actively managed U.S. bond mutual fund that gives the manager the latitude to buy whatever U.S. debt they want, whatever publicly traded U.S. debt they want, with the exception that half of it has to be in AAA rated bonds, and the other half of it can be invested in bonds of any credit rating. Well, they might have U.S. government debt as part of that AAA portion. And so if the U.S. government debt is downgraded from AAA to AA+, that might not fit their criteria. They might have to sell some of the bonds, to comply with their investment mandate. And so if that were going to happen, that could potentially put pressure on the U.S. bond market, meaning that there are more sellers than buyers. It pushes down the value of those bonds, and as the U.S. government needs to borrow more money to finance its operations, it might have to pay more in interest, compensate investors with a higher interest rate in order to borrow more money. And that's simply just not something that we've seen since the announcement was made. I mean, that kind of stuff happens in a flash immediately. And what we're seeing right now is maybe just a tiny bit of pressure on day one. The rest of it has been totally resolved. So after doing my homework on this, I learned that the bond market wide investment mandates actually, not unilaterally, but usually list U.S. government debt specifically as part of that AAA rated portion of the portfolio. And so they'll say something like, if half has to be in AAA bonds and half can be in anything else, the language in the mandate is actually 50% of the portfolio must be in AAA rated bonds and or U.S. government debt. So it gives them the option to maintain that allocation even if the credit rating goes down, even beyond where it is now. So I'm not too concerned about this. We saw just a tiny bit of pressure in the U.S. bond market the days after the announcement. It hasn't turned out to put too much pressure on stocks. Again, there's not like any new information came out. It was just kind of strange timing on Moody's to make the announcement. They have an obligation, Moody's, Fitch, and S&P's, to provide an objective credit rating agency. An objective credit rating for all the bond issuers that they cover. And they got in a lot of trouble after the mortgage crisis because all the analysts and portfolio teams doing that analysis, those roles are not terribly attractive to people who work on Wall Street. if you work on Wall Street in downtown Manhattan, you don't make very much money compared to like traders at Goldman Sachs or somewhere else for work. And when you work at Moody's, it's kind of like a second or third tier job that you take if you can't get hired anywhere else, and you don't get paid as much. And so what was happening back in the mortgage crisis, because remember, these credit rating agencies were producing ratings for all those collateralized mortgage obligations, collateralized debt obligations that were part of the reason that the mortgage crisis was as bad as it was. And if you want to learn more about that, or you're interested, you should watch the movie or read the book called The Big Short. It's the one where Steve Carell plays the trader, and Ryan Gosling is the product manager at Deutsche Bank. They go into a lot of detail about how those products are structured and why it was so bad at that time. My point is that while this was all going on, the bankers at Goldman Sachs, Deutsche Bank were entertaining a lot of the analysts and portfolio research people at Moody's, S&P, and Fitch, taking them out to expensive dinners, giving them tickets to football, baseball games, really buttering them up in order to produce a more favorable credit rating on the junk that they were putting together and trying to sell to people. And when this came to light, this was a huge issue, right? And I know that there were lawsuits. I can't tell you exactly what the result of them or what the size of the claims were or anything like that. But this was a big legal problem for all three, and they really had to clean up their act immediately. So I assume they did. I don't have intimate knowledge of this stuff anymore, but I assume that they did, and now they feel that pressure to just be objective and, hey, even though any no new information has come out, we're going to stick to our guns and maybe even be a little bit conservative when we decide to drop the U.S. government's credit rating. So every time this has happened, back in 2011 by the S&P, back in 94 with Moody's, at some point later in the next, I want to say 12 to 24, 36 months, the same issuers have improved the credit rating and brought them back to AAA, brought the U.S. government back to AAA. And that move back to AAA, I don't believe caused a huge, spike in the markets or anything like that. So big picture here is I'm not too concerned about this drop in credit rating. We do have a long-term issue in our federal government of adding to our deficit, adding to our federal debt. We can afford to spend a little bit more than we make in tax receipts every year, as long as we keep promoting capitalism and entrepreneurship, because the more new and the more efficient we get as a society, which is when entrepreneurship is, which is what entrepreneurship and capitalism really pushes and boosts, that will put more throughput into our system that the federal government taxes, meaning it pushes corporate profits, the government taxes that, and that improves tax receipts. So long term, we can continue borrowing a little bit more than we spend, spending a little bit more than we earn, and borrow the difference. Governments can do that. Individuals cannot do that. It's totally different than what you and I ought to be doing in our personal households. But governments can, because they have very long time horizons and improving economies, more efficient economies over time. It's totally apples and oranges. The problem I see is that we take on too much debt too fast. And this is probably no surprise, but the reason that this happens, I think, is we have new presidents elected every 4 years. We have senators that are elected every 6 years. We have a House of Representatives that's elected every other year. And those officials are always trying to make their constituents happy to get reelected. What's the only thing that a first-term president wants? It's to have a second term. What is the only thing a second-term president wants? It's to get their party their successor in their party reelected after they're out of office. And because of that time frame, our system just dooms us to think in short-term intervals and neglect the long-term costs of that. And I mean, I don't have a solution for that. That's above my pay grade. If we started from scratch, we could probably brainstorm some pretty good ideas. But that's just a fault of the system. And you hear this term of late stage capitalism being tossed around quite a bit. This is exactly what we mean. We have a whole bunch of federal debt. We have to pay interest on that debt. And that means that of all the money coming in from our tax receipts, some of it has to go toward paying interest on the debt that already exists. The stuff that we borrowed way back when, 5, 10, 20 years ago. Whatever money is left over after paying interest on the debt that already exists, that's what we can allocate to this year's budget and go build new roads and pay our federal employees and send money to Ukraine and all the stuff that we're spending money on. So that's an issue. And the more debt that we take on, the higher our interest rates rise, the more of our tax receipts are eaten up by that debt service every single year. The less is left over. So we can continue doing this for a little while, but it means that our economy has to be good. We have to continue innovating and producing corporate profits that are taxed so that we can balance that equation. But what happens in late stage capitalism is at some point the debt service becomes too great. And fast forward, 10, 20, 50 years, if nothing big changes, the amount of our annual revenues that have to go toward servicing the debt that exists from the money that we borrow is going to be too high for us to sustain. And that's kind of the breaking point. And that's when other countries, other investors, other businesses around the world are not going to be quite as comfortable holding US dollars. That's when we really are at risk of losing the US dollar status as the reserve currency of the world. So that's what I'm saying. Realistically, what this means for us as investors is we should be globally diversified. I've probably said it a million times. A lot of people like to just be focused here in the US. We have the strongest, the biggest economy and the most diverse economy in the world, but we're losing our competitive advantage in economic and political power on the global stage comparatively, just a little bit, every single year. So just buy some stuff in other countries, developed economies, emerging economies, buy stuff that it holds stuff in your portfolio that has exposure to other currencies that might benefit from the dollar's decline. It can be an index fund. I'm not someone who hates on index funds. I do think that there's a better way to structure it, but that's a topic for another day. That's basically the problem, right? And so just to have diversity in your portfolio, have a reasonable exposure to international and emerging market stocks. Of all your equities, try to shoot for at least 30% in non-US issues, non-US countries, or companies domiciled in countries other than the US, I should say, because their currency exposure is going to be different, and that just builds diversification. So that's it for today. I hope this was helpful. I'm not too concerned about it. It's something that we should certainly pay attention to. If it gets downgraded again, that will be interesting to see. If one of the other 3 credit rating agencies downgrades the US debt the same way that Moody's did, I'm not too concerned about it. I'll be following the markets to see what happens as a result. But the other rating agencies may have just come to the same conclusion that Moody's did, which is realistically not that big of a deal. So that's it for this week. Hope this was helpful, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.